Fed Chair Jerome Powell gave his speech this week, and the market reaction was volatile to say the least. We've all seen the memes of when he says, "Good afternoon," the markets immediately tank, and that is what happened this week.
Good afternoon.
This time, though, I think there is a real reason behind why the market went down. It did recover eventually, but this is why I think the market went down.
A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it.
He had a prepared statement to make sure everyone knew that the December rate cut is not a foregone conclusion. This kind of highlights the tricky situation they're in. On one end, they have inflation above their 2% target, hovering around 3%. On the other end, they do see weakness in the labor market. And we've all heard AI is replacing jobs at a faster rate. It's going to be replacing jobs even faster. Robotics is taking jobs. So they are in a tricky situation. And right here, even Powell admits the risks of higher inflation and lower employment on both sides right now.
In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate.
What's even more interesting is the Fed themselves are extremely divided on what to do in this economy. They ultimately went with a 0.25 basis point cut, but they did have two dissents, not even towards the same goal. One wanted a bigger cut, and another board member wanted to just keep rates the same. The last time there was two dissents in opposite directions was in 2019. So that just highlights the indecisiveness and the tricky situation that they are in today. Honestly, I'm starting to think stagflation, slow growth, and high inflation could actually be a real possibility. I mean, think about it. The government keeps spending to oblivion. The Fed just announced they're going to be buying treasury bills next year, which is essentially just more money printing.
Just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in treasury bills.
Artificially lowering rates. And we do know AI is taking more and more jobs. That's a cocktail that could lead to stagflation, and even Powell is unsure how to handle it. Here's my favorite question was by Michael McKee when he asks directly if we are in an AI bubble and if lowering rates is actually helping fuel the bubble.
Do you have any concerns that equity markets are or are close to being overvalued at this point?
You know, we don't look at any one asset price and say, hey, that's wrong. You know, it's not our job to do that. We look at the overall financial system and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized. While some households are clearly under stress, in the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
So Powell sort of brushes it off, saying that they don't directly control asset prices, which is kind of a weak answer. And then Michael McKee doubles down on it and says that lowering rates actually does increase asset prices.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI, of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why we're going. That's why the pace we're going has been a careful one.
The uncomfortable truth is this market does show early signs of past bubbles. A lot of people like to compare it to the dot-com bubble, but Powell made a good point how those companies were all speculative, no real earnings. Today, at least our Mag 7 companies and a lot of the S&P 500 all have real solid earnings.
So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these are ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing.
I personally think this bubble is more like the 60s and 70s. There was a group of 50 blue chip stocks called the Nifty 50 that everyone thought would just always go up forever. Eventually, valuations got way too high, and it all came crashing down in like 1973. What followed after was a decade of stagflation with slow growth and high inflation. I'm not trying to be doom and gloom. It's just important to think about these things, because people in the past have been in the same situation where they just think the markets are going to go up forever. You have to be prepared. If you have a good job, keep it. Pay down any bad debt, build savings, put it in a nice high yield savings account, and always invest your money. What did assets do in the 70s after the bubble burst? Metals like gold, silver, all did extremely well. Real estate at least kept up with inflation, while stocks were hit the hardest. This could provide a buying opportunity if we do have a bubble burst, but I know that's a double-edged sword, because when that happens, people lose jobs, people, declare bankruptcy. So this is why it's also important to eliminate any bad debt and build your savings. For me, I'm still buying every time I get paid. Money goes right into my brokerage account to buy ETFs and stocks that I trust right now. If you want to see what I'm buying, I made a video last week covering that. Again, though, I'm just some guy on the internet. Take what I say with a grain of salt. Do your own research. And then there is the possibility that the Fed just keeps the system propped up as long as it can. We don't know how long this will keep going, so the always be buying approach protects you there as well. In case the prices just keep going up, you'll be invested, because time is your most valuable asset. It doesn't matter when and how much money you start with, you must invest in the market. Time will be your best friend. So yeah, maybe we're in a bubble, maybe we're not. All that I know is that you have to eliminate bad debt, build your savings, and always be invested wisely and smartly. If you liked this video, please hit the like and subscribe button, and comment below if you think we're in a bubble and what you're doing about it, what your investments are. I love to hear other people's opinions. Also, I make videos on video games, RuneScape, Overwatch, Battlefield, just about anything that interests me. Thank you so much for watching, and stay smart out there.